Good day, this is Justin Hughes, Head of Raw Materials at CRU. I'm going to give you the aluminium market outlook today. It's an exciting time, certainly for the aluminium market. It's a transitional time for the commodity markets in general. I'd like to give you not just the market outlook, but also cover three additional topics today that are related to the aluminium market and will be influential over the coming 12 months and beyond. So I showed you this chart in September, and it's about the phases of the COVID recovery, looking at where we are now. We're on the long slog. Central banks and governments are active in their prodigious use of monetary and fiscal policies. It's going to take some time to get a true image of the resilience and stability of economies around the world. What is clear is that China's recovery and ability to capitalize over the last 12 months has seen differing paces of GDP, industrial production and consumer confidence region by region. In terms of aluminium, there's been a dramatic recovery post COVID, or certainly the darkest parts of the COVID outbreak. There are vaccines rolling out, leading to easing in lockdowns. And we do have a clearer picture of the path going forward globally that will take in both industrial and consumer sectors. So today we'll not just look at the market outlook, as I say, we also will look at the electric vehicles, the growth expected there and the change in aluminium intensity, but also the demand overall. We'll look at the emission scopes, the move towards a greener ESG and a greener aluminium value chain that's going to also change the shape of the cost curves. And more broadly, commodity price inflation and the concept of a super cycle and the CRU view therein. Obviously, I welcome any questions directly. We always appreciate the conversations we have with members, even in this virtual setting. So we'll just look at upstream for a moment here with bauxite and alumina markets. So with bauxite, China is expected to drive sizable gains in the third-party bauxite consumption market over the next 5 years. Considering the bauxite situation in China, most of the alumina refineries intend to use imported bauxite. This includes several upcoming alumina refinery projects in Guangxi and Inner Mongolia. Global third-party bauxite demand is expected to reach nearly 190 million tonnes by 2025. So that's up from 35 million tonnes from 2020 levels, so significant growth there. Chinese bauxite imports are expected to reach just below 150 million tonnes by 2025. There's been a large amount of investment in Chinese low temperature technology, and so additional imports will be based on that information. In terms of pricing, the bauxite prices have been fairly stable, but they also reflect developments in the ocean freight market, given the distances travelled when we look at bauxite on a CIF China basis, which is generally the baseline used. So although Capesize freight rates have returned to more settled levels and seen a reduction in the volatility for Guinea bauxite prices, the main uncertainty for this year, 2021, will be still those ocean freight rates. So in the alumina market, it's a surprising return to long-term rates, roughly at the moment with $300 approximately alumina on both a Pacific and Atlantic basis, and with aluminium touching $2,200. We're roughly around 13% of LME, which is a longer-term contractual level that for a long time with LME-linked contracts was embedded into contracts. So we are looking at a well-supplied market. China are importing, but there is a plentiful amount of capacity. So we do expect about 12% of alumina production to have been loss-making in Q4 last year, and the vast majority of that loss-making capacity was in China. The share of loss-making production in China really was around 20%, and then 2% in world ex-China. The winter supply cuts that took place were primarily in the major production area of Henan, but there's also swift restarts and disrupted capacity in Shandong. It's been counterbalanced by some ramp ups of new refining capacity in China. So that's about 1 million tons per year at Lubei Chemical, a similar amount at Guangxi Longzhou refinery, and full production being reached at the 2 million ton per year Guangxi Fangcheng Gang refinery. That's one of the most well-known projects that's been touted for years. But also outside of China, alumina capacity continues to grow, and there's been recent developments in Indonesia with the start of a 1 million ton greenfield Bintan alumina project, and also Kindawangang, the brownfield, 1 million tons there, as well as capacity gains in India with Hindalco at Utkal and Vedanta at Lanjagar. So we look at the alumina surplus. We think around 700,000 tons will limit the upside for the alumina price. We think that the API, that's CRU's alumina price index, will remain stable at around $305 a ton for the balance of this year. But we also see a decline in Chinese imports. We think 3 million tons per year for 2021 versus 3.8 last year. So now we can move on to the aluminium market. Here's a brief overview of what's to come. World ex-China output rising by 4% this year, and that's the second highest year-on-year tonnage growth in the last 20 years. World ex-China demand will rise by over 12% this year, and in China demand will rise by nearly 6%. Global market surpluses this year will fall to 1.4% from 1.4 million tons from 2.5 million tons last year, and we expect the LME price to rally to a high of $2,350 a ton over the next 3 months. So let's look at that in a little bit more detail. Primary aluminium demand, as I say, is expected to rise by 12% this year, but that remains just below 600,000 tons, below the 2019 levels. But the key developments here are rolled product production this year will be 300,000 tons higher than 2019. Rolling company shipments year-on-year growth in Q4 was stronger for extruders. The risks are that billet availability in the US is tightening, to a less extent in Europe. Given the freight rates, there may be a shortage of billet in these markets in 2021, and that companies lack some visibility and confidence for the second half of this year, but particularly in the States with stimulus, it does lessen our concerns about the demand recovery. In China, primary aluminium demand will rise by 5.7% this year. The developments here are that the travel and length of plant closures over the Chinese Lunar New Year are down from previous years, and there's less severe seasonal slowdown. In Q2 to Q4, year-on-year demand is expected to slow. So the Q2, Q3 substantial restocking won't be repeated. Scrap availability will improve, and that's going to depress primary metal demand. The risks here, well, the Chinese economy will be strong in 2021, and this should deliver more growth from construction and transport markets and lift primary demand in Q2 to Q4, giving upside demand of 1 million tons for 2021. I think the risks here are fairly limited. So on to the production side. Rest of world production is expected to rise by 4% year on year, slightly lower than what we were previously estimating as of late last year. So the key developments here are Vedanta nearing completion of their 250,000 ton additional potline at Zagada. Press Metal ramping up over 300,000 tons this year, and Rusal adding over 400,000 tons at the Tashet plant as of next quarter. The risks here, well, there's a lack of closures, so that's boosted production in World ex-China, but we've not seen all the restarts delivered upon. So that demonstrates that capacity utilization is very high in World ex-China. We think getting up towards 90% as of 2021. We exclude Venezuela and Tajikistan there, which is just slightly above 90%. Going into China, Chinese production is set to increase by 7.9% year on year. That's a rise of nearly 3 million tons from last year, so significant additional production rates. The key developments here are in Mongolia. They were ordered 3 plants in the region to curtail output to reduce the coal consumption after the province exceeded central government limits. So those limits can be seen negatively, but it does show how high utilization rates were in Inner Mongolia for aluminium production. So we do think around 150,000 tons of capacity will close this quarter. That's part of our disruption allowance. Heavy storms and rain in Yunnan have been 25% below historical averages, so that will slow ramp-ups. We think around 1 million tons of constructed capacity is yet to operate. So the risks there are central government blocking ramp-up of smelters in Inner Mongolia. That could lower our total production by as much as 400,000 tons this year and up to 700,000 tons next year. Central government intervention remains a major risk always in China. So looking into inventories, global inventories in Q1, seeing nearly 1 million ton surplus and 1.1 million tons in China, with small stock decreases in the rest of the world. World ex-China premiums are rising in all regions as demand recovers. So with inventories in the US falling by between 30 and 50,000 tons a month on low imports. European inventories are flat, and stocks in Asia outside of China will only start to rise in Q2. But in China, there's been year-to-date increases in stocks, including billet, but we do expect stocks to peak by the end of Q1. So the total balance here, the outlook is that global surplus will drop to 1.4 million tons in 2021, and that's really down to a growth in global demand. In China, the market is very well balanced. We've increased our surplus slightly from Q2 onwards due to those higher primary aluminium imports. For World ex-China, there is modest demand upgrades and slightly lower production and lower surplus in 2021. The bigger impact is from the Chinese primary aluminium imports, but if recovery in demand can take us to those 2019 levels, that would add about 600,000 tons to the World ex-China demand. Into premiums here, in the US Midwest, imports are down year on year. There's a tight physical market, and we expect freight will send the Midwest premium to 20 cents per pound in Q2. For Rotterdam in Europe, the premiums are holding steady. The upside there is limited by the very tight spreads on the LME aluminium contracts. And in Japan, premiums are set to rise to around $135 per ton in Q3. We know that sellers are looking as high as 160 plus, but buyers are looking still around the $140 per ton level. So on to the LME price forecast. In the next month, we do expect strong stimulus, so some potential inflationary pressures there. The price on the LME has tested the upper bounds, the 2200 level. We could now enter a period of consolidation. And if we look at what's happening in the copper and nickel market, aluminium may still follow that trend. But over the 3 to 6 month period, we do think there's upward pressure on prices. There's a continued recovery in the global economics, in global economies, and there's an expectation that central banks will remain fairly dovish until those economies are in better health. For the SHFE aluminium price forecast, the aluminium cash price is expected to move above 17,000 RMB per tonne, and that's mainly due to constraints on supply. This counters the argument about the rising stock levels and potentially 3 million tonnes of additional capacity coming online for 2022. We don't see really much upside in the SHFE price over the short term, unless more smelters are ordered to close, and we have no information that would signal that. But over the medium term, the import arbitrage has opened up, but ultimately we don't think China will need to import in 2021, so the price shouldn't hold to those levels. So now I just want to cover three of the major themes. The first one is the move from internal combustion engines to electric vehicles. Environmental policies to control carbon emissions are climbing up the policy agenda and have led to a surge in electric vehicle sales. This has a big impact on the aluminium industry that creates opportunities for producers to potentially dominate the battery casing market. Battery casings include all aluminium used in the battery pack, plus the housing for that. We expect by 2025, which is the end of our forecast period, that electric vehicle battery casing demand will rise to 1.4 million tonnes of aluminium, up from only 100,000 tonnes in 2015. We expect electric vehicles to account for 25% of all car sales by 2027 and over 50% of car sales by 2034. Hybrids and plug-in electric vehicles will be key to that transition to electric vehicles, but I think as consumers become more environmentally conscious, fully battery electric vehicles will become the most popular choice. So it's all about aluminium intensity in terms of batteries. Battery electric vehicles are continuing to evolve. There's improving battery technology as they shift towards larger, more powerful batteries for obvious reasons, primarily range rather than speed or those sorts of metrics. Larger batteries have more cells, larger casings, so they have a higher intensity of aluminium. We forecast over the next 5 years that these batteries will continue in that vein to become larger, more powerful. So as EV production increases, we expect there to be a demand increase in aluminium. We think that over a 5-year period that will grow around 30%. So nearly 500,000 tonnes in Europe and around 300,000 tonnes in North America. So the next topic is green aluminium and low carbon, and that will lead us into emissions. I've shown you this slide before, and I think you'll hear more about the idea of green premiums and potentially even green aluminium contracts being traded on exchanges. Right now, a premium attached to material is really at the discretion of the buyer, whether they want to opt for a seller that has hydro, thermoelectric or to a lesser extent renewable and nuclear power rather than those that are coal-fired. As of yet, the LME and other exchanges have only really extended to discussions, but it's a key part of the industry, and certainly the decarbonisation of the aluminium and steel industry will be a hot topic for years to come. But you'll hear a lot about emissions and emissions definitions. So what do primary producers really have to do here? Well, Scope 1 direct emissions generally account for about 45% of total emissions for an aluminium smelter, owing to the contained nature of that sector. Many of those come from internal production facilities and machinery, but primary aluminium producers also have extensive transport emissions, getting their products to downstream consumers, and the emissions from fuels which are used to power their operations. So that all adds to Scope 3 emissions, which in total a couple of years ago was nearly 40 million tons of carbon. So what can primary producers do? Well, given nearly half the emissions come from internal operations, the next step is to build cleaner and more energy efficient operations. So that's focusing on cutting down fossil fuel usage, shifting to renewable sources to cut down on Scope 1 and Scope 3 emissions, and to optimize transport and logistical routes. So additionally, there's going to be upgrading of machinery and equipment as it's worn out, and that will improve efficiencies in energy and overall reduce emissions. The last topic is something that certainly some major investment banks have been pushing and talking about, as well as the popular press, and that's the idea of a commodity super cycle, and whether we are either in one, have been in one for 9 months, or will move into one in the next year. And there's a lot of differing opinion on this, but I'd like just to present the CRU view that it's slightly too early to call for a super cycle. So I've got a couple of slides here to run through the view. I think fundamentals and sentiment suggest that this year we'll see elevated margins for the likes of steel, aluminium, and other non-ferrous metals, but we don't think that a super cycle can be called here. Generally, technology is the key, and a super cycle is a multi-decade phenomenon, not something that's simply established in a single year. History shows that super cycles are overlaid with shorter business cycles, so price spikes and dips that last up to 5 years. The CRU view is that commodity prices are being supported by temporary factors that will recede, and we do not expect a prolonged commodity boom like in the 2000s that was underpinned by a demand spurt in China, once in a generational shift there. And while there are some supply restrictions, capacity has not been eroded. And then the move towards green focused economic stimulus, which seems to be the popular term right now around the world, is important, but it's too early to see how supportive this will be for real commodity demand. What we do in terms of defining a super cycle, so we have to look at temporary price spikes lasting between 1 and 3 years. Generally, they're caused by shortages in stocks or supply disruptions or a sudden burst in demand, but generally these are deemed business cycles. Then we look at long-run pricing trends between 5 and 20 years. That's the peaks and troughs determined by classical supply and demand, ultimately moving towards the long-run marginal cost. Then the third component is a super cycle, typically lasting longer than 20 years, caused by years of low investment, insufficient capacity, and historically low prices. So a shift in political and environmental factors holding back supply, and a large and persistent step up in demand can further support a super cycle. So in terms of aluminium, China's aluminium demand has rebounded, but smelters were a little slow to react. We do see rising aluminium prices as the primary driver for a response to that rapid demand rebound. The strength of the Chinese demand in 2020 has left a massive shift within the Chinese aluminium trade. Net imports are up, aluminium scrap and ingot imports are up to nearly 3 million tonnes. We've seen large price rallies in China, nearly 50% from the lows of Q1 2020. That's increased profitability to near decade highs. So the combination of Chinese demand rebounding, increasing imports, and sluggish response from producers to increase their output is the driver behind aluminium prices. But again, we think that these are temporary factors. So the final slide here is just to show you our matrix of what we consider, and I think it's a good idea to put it against the other areas that we cover, which are the base metals, fertilizer, and steel. Demand for aluminium is going to come from renewable energy. Electric vehicles will be the key source of growth over the next 5 to 10 years, but still will only account for a smaller portion of consumption by 2025. So we deem that in the short to medium term. Capacity constraints will arise in China from 2023 and beyond. But by that stage, we forecast that Chinese companies will be able to start constructing smelters outside of China, such as in places like Indonesia. That's part of the One Belt, One Road policy. These new plants will typically have a lower capex, and ultimately a domestic Chinese capacity constraint will result in deflationary capex world ex-China. And finally, aluminium is a highly power-intensive commodity, but if China restrict output more substantially than we forecast, carbon costs may spiral in the rest of the world, and new coal-powered smelters may fail to secure funding. The bullish case is that this occurs and the move to electric vehicles and renewable energy happens faster than we anticipate. So generally, commodity prices to remain strong this year. We're going to see economic recovery, some inflation, low inventories, and some lagged effects and disruptions to the supply chain as we move into a post-COVID world. So we don't think there's enough here for a super cycle, but we will continue to discuss emissions, ESG, move to electric, and I think the idea of green aluminium will be a hot topic. I'll finish up there. Thank you for your time. As always, I very much welcome questions, whether directly or through the association. Thank you for your time, and we look forward to hearing from you.